20 years, the same market, the same $10,000. One path ends at more than 80,000. The other ends at 35,000, just by missing 10 days. At the same time, by mid-2025, the 10 largest companies in the S&P 500 made up almost 40% of the entire index. And in one well-known venture dataset, about 6% of investments generated about 60% of total returns. 3 different domains, 3 different timescales, same pattern. A tiny fraction of outcomes explains a huge fraction of the result. Most people come into finance thinking the market is mainly a story about averages. Average return, average year, average volatility. But a lot of real finance is not governed by the average. It is governed by tails, concentration, and rare outliers. And if the distribution is wrong, the intuition is wrong. If the intuition is wrong, the risk model is wrong. This video is about the distribution that secretly runs finance. Here is the mistake that quietly breaks a lot of financial intuition. People think in averages, but wealth does not grow by averaging outcomes. Wealth grows by surviving a sequence of outcomes, one after another. That is a very different process. 2 investments can have the same average return and still feel completely different in the real world. Their drawdowns are different. Their recovery paths are different. Their timing risk is different. Now add the statistical model most people carry around in the back of their minds, the bell curve. In a normal distribution, large deviations should become dramatically rarer as you move into the tail. That is why the bell curve feels safe. It is smooth, symmetric, and orderly. But finance gets dangerous exactly where that intuition is weakest, in the extremes. Because in markets, the center can look calm while the tail still does the real damage. The right question is not only, what is the average outcome? The right question is, how much of the final result is being driven by rare events? Now, test the clean theory against dirty reality. The Society of Actuaries reviewed 2020 equity returns using the S&P 500 Total Return Index. In March 2020 alone, there were 4 trading days with moves greater than 9% in absolute value. Under a normal distribution framing, those moves corresponded to z-scores above 8. That should already make you uncomfortable. Because in a Gaussian world, events that extreme are supposed to be almost irrelevant to ordinary market history. And yet in real history, they showed up 4 times in 1 month. The same study reported excess kurtosis of 8.04 for 2020 equity returns. A normal distribution has excess kurtosis of 0. So, 2020 was not just volatile, it was shaped different. The tails were materially heavier than a Gaussian model would suggest. And this is not only a COVID story. The Federal Reserve's retrospective on the 1987 crash states that on October 19, 1987, the S&P 500 fell about 20% in a single day. That is the lesson. Real markets may look civilized near the center, but they become much more violent in the tails. The normal approximation can still be useful near the center, in calmer regimes. The real mistake is pretending it remains trustworthy all the way into the extremes. Now leave abstract statistics and move into compounding. J.P. Morgan's 2026 Guide to Retirement shows what happened to a hypothetical $10,000 investment from January 2, 2006 through December 31, 2025. Fully invested, it grew to $80,619. Missed the 10 best days, and the ending value falls to $35,866. Missed the 20 best days, and it falls again to $21,000. This is where tail dominance becomes emotionally real. Your ending wealth is not being shaped evenly by thousands of ordinary trading days. It is being shaped disproportionately by a tiny handful of explosive ones. And then comes the twist that breaks the simplest version of market timing. In that same J.P. Morgan exhibit, 6 of the 10 best days occurred within 2 weeks of the 10 worst days. 5 of those 6 came after the worst days. In other words, rebounds often live inside panic. So the idea that you can just step aside during chaos and come back when it feels safer sounds clean in theory. But in a fat-tailed, volatility-clustered market, the days you are most likely to avoid may also be the days you most need to capture. Ordinary days shape the market. Extreme days dominate the outcome. Tail dominance is not only about time, it also shows up across names. S&P Global and Vanguard reported that by mid-2025, the 10 largest companies in the S&P 500 represented almost 40% of the index, a concentration level not seen since the mid-1960s. That matters because S&P 500 sounds diversified, and in one sense it is. But 500 constituents does not mean 500 equal drivers. S&P Dow Jones Indices shows that from June 30, 2005 to February 28, 2025, the S&P 500 Top 10 Index had an annualized return of 12.13% versus 10.67% for the full S&P 500. It also had higher annualized volatility, 16.86% versus 15.09%. That does not prove concentration is always better, and it does not mean the broad index is obsolete. It means a broad index can still be heavily driven by a narrow set of winners. Breadth of membership is not the same thing as breadth of contribution. If public equities suggest concentration, venture capital screams it. AngelList analyzed more than 10,000 LP portfolios and found that broader exposure across companies improved results. On average, median annual returns increased by 9.0 basis points and mean annual returns increased by 6.9 basis points for each additional company an LP was exposed to. That result is consistent with a simple intuition. In a market dominated by a few huge winners, a small portfolio can easily miss the handful of outcomes that matter. AngelList's related returns study goes further. Using a set of 1,808 early-stage investments, it found a strongly power law-like right tail with enormous positive outliers skewing portfolio performance. On a log-log plot, the power law fit stays roughly linear, while the log-normal benchmark curves away. And the classic Horsley Bridge result, cited by Andreessen Horowitz, makes the concentration impossible to miss. About 6% of investments, representing 4.5% of dollars invested, generated about 60% of total returns. That is the same structure again. A few days dominate compounding. A few names dominate the index. A few winners dominate the venture portfolio. But this is also where discipline matters. Outliers dominating the asset class does not mean the average participant experiences an outlier outcome. The British Business Bank reported that UK venture funds from the 2002 to 2020 vintage period generated a pooled TVPI of 1.84 times versus 1.95 times in the US and 1.85 times in the rest of Europe. So yes, the tail dominates the economics of venture, but no, that does not make venture returns easy, typical, or glamorous. At this point, fat tails stop being a descriptive curiosity and become a pricing problem. If extreme losses are more common than a bell curve suggests, then simple volatility-based intuition can understate real downside risk. If downside states matter more, then protection against those states should be expensive. That is one reason crash insurance rarely comes cheap. Kelly and Jiang take this one step further. Their tail risk measure, built from the cross-section of stock returns, is significantly correlated with tail risk measures extracted from S&P 500 index options. In other words, two different ways of measuring the same danger point in the same direction. They also show that a one standard deviation increase in tail risk forecasts about a 4.5% increase in excess market returns over the following year. And cross-sectionally, stocks with high tail risk loadings earned annual three-factor alpha 5.4% higher than stocks with low tail risk loadings. Plain English. Markets notice the tail, price the tail, and demand compensation for bearing the tail. That is why this topic matters so much. It connects market history, options pricing, diversification, expected returns, and venture portfolio construction under one statistical lens. Now for the honest limit. This video is not saying every market series is a pure power law, and it is not saying the normal distribution is useless. Near the center, Gaussian tools can still help. The problem is using a thin-tailed model exactly where finance becomes consequential. Some of the evidence here also carries caveats, including back-tested index history and private market data limitations. So the right takeaway is narrower. Tails matter much more than average-based intuition suggests, and in many important cases, they dominate the outcome. So the better first question is not just what is the average return, it is, what distribution am I actually dealing with? A few days can dictate decades, a few companies can dictate an index, and a few outliers can dictate a portfolio.